For many homeowners, a mortgage payment can feel fixed. The loan was signed, the interest rate was set, the monthly payment was calculated. Yet for millions of households, the amount due each month can still change, not because the homeowner moved, refinanced, or changed the loan, but because another part of the housing bill is rising quietly inside the payment: homeowners insurance. For many borrowers, homeowners insurance is not paid separately once a year. It is often collected through an escrow account as part of the monthly mortgage payment. When the insurance premium rises, that increase can become a higher monthly housing payment after the mortgage servicer reviews the escrow account. To the homeowner, it may simply look like the mortgage went up. But the pressure begins elsewhere. It begins with insurance premiums, expected losses, rebuilding costs, storm damage, risk models, state markets, and the way mortgage servicers collect money for taxes and insurance. This is why home insurance has become one of the hidden housing costs facing American households. Newrez released a study on April 30, 2026, based on roughly 1.2 million residential mortgage loans it serviced. The study found that average annual homeowners insurance premiums tied to escrow accounts rose from $1,997 at year-end 2021 to $2,625 at year-end 2025. That is a 64% increase. For a household, this is not just an insurance statistic. It is a housing cost statistic. If insurance is paid through escrow, the annual increase can be divided into monthly payments. It can show up in the same bill that also includes the mortgage. And it can arrive even when the homeowner did not buy a new home, did not take out a new loan, and did not choose a larger monthly payment. That is what makes the cost feel hidden. The payment changes, but the reason may be buried inside the escrow portion of the bill. Fannie Mae explains that an escrow account holds money for property taxes and homeowners insurance. Part of the monthly mortgage payment funds that account. The servicer then uses the account to pay those bills when they come due. Each year, the servicer can perform an escrow analysis. If taxes or insurance have risen, the total monthly payment can be adjusted. That is the mechanism behind the story. An insurance premium rises. The escrow account needs more money. The mortgage servicer adjusts the payment. The homeowner sees a larger monthly bill. The loan itself may not have changed, but the cost of owning the home has. Newrez found that premium growth slowed to 10% in 2025, the slowest rate since 2021. That slowdown matters. It suggests the pace of increase may have eased compared with earlier years. But slower growth is not the same as lower costs. The average premium in Newrez's data was still much higher than it had been at year-end 2021. And for households already dealing with high mortgage costs, property taxes, utilities, repairs, and debt, even slower premium growth can still add pressure. Pew Research Center reported on May 6, 2026, that 71% of U.S. homeowners said their home insurance costs had gone up over the last few years. The survey was conducted from March 16 to March 22, 2026. That finding shows the issue is not only visible in servicing data. Homeowners themselves are noticing it. Pew also found that 42% of homeowners said their insurance costs had gone up a lot. Among middle-income homeowners, 75% said their costs had gone up over the last few years. For a middle-income household, housing is usually one of the largest monthly expenses. When one part of that expense rises, it competes with everything else in the budget. Groceries, gas, electric bills, car payments, medical costs, debt payments, and savings. A higher insurance premium may not arrive with the same visibility as a grocery receipt or a gas station sign. But if it raises the monthly housing payment, it can affect the same household decisions. The causes behind higher insurance premiums are not simple. The verified evidence points to several pressures at once. Insurance premiums are tied to expected losses. When insurers expect higher losses from claims, the cost of coverage can rise. NAC-related materials identify several factors behind higher homeowners insurance premiums, including more severe and frequent catastrophe events, construction cost inflation, exposure growth in high-risk areas, and legal and claims cost pressures. That means the insurance bill is connected to a wider system. Storm damage affects claims. Claims affect expected losses. Expected losses affect premiums. Premiums affect escrow accounts. Escrow accounts affect monthly mortgage payments. Monthly mortgage payments affect household budgets. This is the same kind of chain that appears across many cost-of-living stories. A pressure begins upstream. It moves through an industry. It reaches a bill. Then it becomes a monthly household problem. The Insurance Information Institute reported that severe convective storms caused $51 billion in U.S. insured losses in 2025. It was the third straight year above $50 billion. Those losses matter because insurance is built around risk. When losses are large and repeated, they can put pressure on pricing. They can also influence how insurers view different regions, different homes, and different kinds of exposure. The Institute also reported $68 billion in economic damages from severe convective storms in 2025. That number includes broader damage beyond insured losses and shows the scale of damage connected to storms, repairs, and rebuilding. For homeowners, the result may not be immediate or direct in every case. A storm in one place does not automatically explain every premium increase in every state. But repeated high-insured losses are part of the pressure facing the insurance system. GAO reported in February 2026 that premiums in zip codes with severe or extreme wind or wildfire risk grew faster than premiums in areas with major risk. Since 2021, GAO found annual premium growth of 6 to 10% in those severe or extreme risk areas, compared with 1 to 4% in major risk zip codes. The pressure is not evenly distributed. Some homeowners face more risk exposure than others. Some markets face more availability pressure than others. Some states and regions may see insurance costs rise more quickly because of local conditions. GAO also reported that fair and beach plan market share rose from about 1.4% in 2019 to about 2.5% in 2023. These plans are often used when private insurance is harder to obtain. That does not mean every homeowner is being pushed out of the private market. But it does show that in some areas, insurance availability has become part of the housing affordability problem. Cotality highlighted state-level escrow pressure as well. It reported escrow payment increases of 55% in Florida and 57% in Colorado in 2025. These examples show that the problem is not limited to one type of risk or one region. Florida is often associated with hurricane and coastal risk. Colorado can be connected to other exposures, including wildfire and severe weather risk. The broader point is that insurance pressure can show up in different ways across the country. Cotality also forecast national insurance premiums would rise 8% in 2026. That should be treated carefully. It is a forecast, not a confirmed result, but it is a signal that analysts still expect premium pressure to continue. For homeowners, the distinction between a forecast and a confirmed increase matters. A forecast does not guarantee what will happen to one household, but it does suggest that insurance costs remain a cost of living issue to watch. The homeowner experience is often different from the industry explanation. Pew found that among homeowners whose insurance costs had gone up, 65% cited insurer profits as a major reason. 61% cited repair and rebuilding costs. 46% cited extreme weather. Those numbers are important, but they must be handled carefully. They show what homeowners believe is driving the increases. They do not prove the exact causes of insurance pricing. Still, they reveal something valuable. Many homeowners are trying to understand why a bill they may rarely think about has become more expensive. From the homeowner's perspective, the details of insurance pricing can feel distant. They may not see expected loss models. They may not see reinsurance costs. They may not see state filings, claims costs, or risk zone maps. They see the renewal notice. They see the escrow analysis. They see the new monthly payment. And they have to fit it into the household budget. This is why the topic connects directly to the middle-class squeeze. A family may have bought a home based on what the payment looked like at closing. They may have planned around the principal and interest. They may have assumed the monthly cost was manageable. But the full cost of owning a home includes more than the loan. It includes insurance. It includes taxes. It includes repairs. It includes utilities. And if any of those costs rise, the household budget changes. For first-time homeowners, this can be especially difficult. The mortgage payment may already be stretched. A higher escrow payment can make the monthly budget tighter than expected. For retirees, the pressure can be different. Income may be fixed or limited. A rising insurance cost can force trade-offs with other regular expenses. For existing homeowners who do not plan to move, the increase can feel frustrating because it arrives without a new purchase. The home is the same. The loan may be the same, but the cost of keeping the home insured is higher. For home buyers, insurance is part of affordability before the purchase even happens. A buyer may qualify for a loan based on the full monthly cost of ownership. If insurance is expensive, that can reduce how much house the buyer can carry each month. In high-risk areas, availability can matter as much as price. GAO's findings on faster premium growth and rising fair and beach plan market share show that some markets face pressure beyond ordinary premium increases. That can affect buyers, sellers, lenders, and communities. If insurance becomes more expensive or harder to obtain, the cost of homeownership changes. This does not mean the same thing is happening everywhere. It does not mean every homeowner has an escrow account. Fannie Mae notes that some lenders require escrow accounts, while some homeowners pay taxes and insurance directly. It also does not mean insurance is the only reason mortgage payments rise. A monthly housing payment may include principal, interest, taxes, insurance, and sometimes other costs. But for homeowners with escrow accounts, insurance can be the hidden line item that changes the total. That is the central point. Home insurance is not just an annual policy. For many households, it is part of the monthly housing bill. And when premiums rise, the effect can become part of the mortgage payment itself. The current data shows a clear pattern. Newrez found a 64% increase in average annual homeowners' insurance premiums tied to escrow accounts from year-end 2021 to year-end 2025. Pew found that 71% of homeowners said their home insurance costs had gone up over the last few years. III reported severe convective storm insured losses above $50 billion for 3 straight years. GAO found faster premium growth in severe or extreme wind and wildfire risk areas. Cotality reported large escrow payment increases in Florida and Colorado and forecast another national premium increase in 2026. Each data point shows a different part of the system. Servicing data shows how premiums changed for escrowed loans. Survey data shows homeowners are noticing the increase. Insurance loss data shows one source of pressure on the system. Government analysis shows geographic risk differences. Property data forecasts suggest the pressure may continue. Together, they describe a housing cost that has become harder to ignore. The story is not that insurance alone is reshaping the housing market. The story is that insurance has become a larger part of the total cost of homeownership. And because it is often collected through escrow, it can raise monthly payments in a way many households do not immediately separate from the mortgage itself. That makes it one of the quieter cost pressures in housing. It does not always come with a new loan document. It does not always look like a new purchase. It may arrive as an adjustment, a notice, or a higher amount due. But the household impact is real. A larger monthly payment leaves less room for groceries, gas, savings, repairs, and debt repayment. It can make a home feel more expensive after the purchase. It can make affordability harder for buyers. It can make fixed-income homeowners more vulnerable to cost increases. And it can make risk-exposed areas more difficult to insure affordably. The causes remain complex. Expected losses, severe weather, rebuilding costs, legal and claims cost pressures, exposure growth in high-risk areas, and market availability all appear in the verified research. But the exact share of responsibility varies by market. That matters because oversimplifying the story would be misleading. It is not only weather, it is not only insurers, it is not only regulation, it is not only rebuilding costs. The more accurate picture is a system where several pressures are moving at once. For households, however, the practical question is simpler. How much will the total monthly housing payment be? That is where insurance becomes part of the cost of living story, not as a separate industry issue, but as a monthly bill. The next signals to watch are the 2026 premium data, escrow adjustment notices, severe storm loss reports, fair and beach plan enrollment, state-level rate filings, and mortgage performance data in areas where insurance and tax costs are rising quickly. Those signals will show whether the pressure eases, continues, or spreads further through the housing market. As of the latest cited data, homeowners insurance remains elevated as a housing cost pressure. Premium growth may have slowed in 2025, but the multi-year increase remains large. Forecasts still point to further premium pressure in 2026, though the size and location of future increases remain uncertain. For ordinary homeowners, the issue is not abstract. It is the payment due each month. It is the escrow notice that changes the budget. It is the insurance renewal that makes the home more expensive to keep. And it is one more reminder that the cost of housing does not end when the mortgage is signed.